On your marks, get set, invest. How do you find investment education that you can actually trust? Do a quick search and you'll find literally thousands of guides, courses, strategies, usually advertised with breathless excitement and annoying plinky-plonky music like this, and all promising that you can make big money. It's hard to know which ones are giving you utterly useless advice, or even trying to sneakily sell you something a little bit whiffy. Well, that's why we're proud to bring you ShareSoc Investing Basics. ShareSoc is the UK organisation that represents individual investors, people like me who own some shares in the UK stock market. They campaign and they fight for your rights. Unlike many guides and courses, this one is unbiased because ShareSoc don't sell any financial products, make investment recommendations, or steer you towards any particular style of investing. ShareSoc is genuinely on your side and wants you to be successful. That's the difference. This video series is sponsored by some of the biggest investment platforms and industry players in the British finance industry. They gave us the money to show you how it all works, which was very nice of them. But when it came to actually making these videos, we very politely showed them the door, because this series is not influenced in any way by those companies or by any companies. It's just the basics that everybody needs to know when they start investing in shares and funds. My name's Glenn Goodman, and I've been investing for more than 20 years now. I was a business correspondent for BBC and ITV News, but as my investments grew and started making me more money than I was earning in my day job, I decided to concentrate on investing full-time. I learned to ignore all the show-offs with their adrenaline-fueled social media profiles, and I read a lot of good books on how to make good money while being careful and prudent at the same time. Studies consistently show that most of those fast-trading gamblers eventually lose all the money in their trading accounts. Investing means buying something like shares or property with the aim of profiting long-term. Trading, meanwhile, is buying and selling for a quick buck. Now, I do a bit of both, but short-term trading is not easy, which is why most people ultimately fail at it. In the race between the tortoise and the hare moved faster, but it was the careful, disciplined tortoise that ultimately won the race. This course will give you the tools you need to spot great investments, manage your level of risk sensibly, and build profits while still sleeping soundly at night. Your unbiased guide to investing starts right here. So let's begin with the basics. What exactly is investing? Well, it's any situation where you hand over some money in the hope that you'll get more money back in the future. But the reason you need a guide like this one is because when people don't know how to do it properly, they often end up getting back less than they put in the first place. Here are some of the things that people often invest in: shares, funds, and bonds. Don't worry, I'll be explaining how those things work soon enough. Also, property, gold, silver, cryptocurrencies, stamps, wine, classic cars, art. All of these things are assets, things that you can own that have value. Now, in this guide, we're going to focus on stock market investing. So let's start with the basics of shares. Let's say I want to invest in an exciting new company called Memepot PLC. Yes, you've got too many internet memes in your life. You've got the Thug Life sunglasses, the epic fail, and of course this one. Now, Memepot PLC will take all your favourite memes and they'll store them for you in a virtual pot. Genius, kind of. Now, owning a share in a company is exactly what the name implies, right? It means you own a piece of the business. And you'll sometimes get a regular share of the company's profits, known as a dividend. Many companies pay these to their shareholders twice a year. The shares are bought and sold, traded between different people on a stock exchange, aka the stock market. Now, they used to do that person to person, then mainly by phone. Now it's usually done quickly and easily over the internet. Now, take the current market price of each share and times it by the total number of Memepot PLC shares in existence, and you get the market value of the company, or market capitalization. So the ups and downs of the share price determine how much the company is actually worth. Now, this is a share price chart. Time goes along the bottom. The price of the share goes along the side. Ideally, you'd want to buy here and sell up here. But in the real world, it's just not quite so simple, because unless you have a time machine, then when you're down here, you've no way of knowing for certain that the price will end up here rather than right down here. To give yourself a fighting chance of ending up here in the clouds, you need to understand the factors that determine the price of a share, that cause it to go up or down, things like the amount of sales that Memepot plc makes from its subscribers, and whether it's making any profit. We'll be examining these factors and many more in detail later on in the guide. You might also wonder, if those were shares, then what exactly is a stock or an equity? Just don't worry, these words all basically mean the same thing. You may also be wondering whether buying shares is actually a good idea or not. Isn't it rather risky? Well, yes, it can be. Is taking risk a bad thing? Not necessarily if it's done responsibly. We take risks all the time. For example, your lifetime risk of being seriously injured in a road accident is 1 in 30. But do we avoid travelling by car or crossing roads as a result? No, most of us decide it's simply too important to our lives. So instead, we try to just take care when driving and crossing roads. Likewise, for many of us, investing for the future is too important to avoid. But we can learn to do it with care. And guess what? Most of the people in the UK are already investors anyway. If you've got a pension, your money is being invested and risks are being taken on your behalf. Do you know what fees you're paying? Do you know where your money's being invested? Well, keep watching and you'll soon be able to understand what's being done with your pension money. That's your future right there, so you need to keep an eye on it. If you're not comfortable with any investing risk at all, you could save your money in a bank cash savings account. This method used to work well for millions of people. They'd save up a nice chunk of cash over their working lives and then earn typically 5 or 6% a year in interest on their savings. At 5%, you could earn £5,000 a year on a nest egg of £100,000. And bigger nest eggs meant very comfy retirements, living off the interest. But in recent years, interest rates have fallen so low that even people with hundreds of thousands saved up are still earning peanuts in interest. The only option for many pensioners has been to eat into their savings year after year. So with cash savings rates so low, many people have now turned to investing instead. And during the COVID pandemic, a lot of people had the time to look more seriously at investing too. I mean, take this young woman, for example. See that egg? That's her nest egg. And she's all like, OMG, how should I invest my nest egg? I don't even know where to start. And then the sensible people in sensible suits turn up saying, put your money in a sensible FTSE 100 tracker fund. What they're telling her to do is get an investment that spreads her money across the 100 biggest company shares in the UK. So basically, she'll make as much profit as if she'd invested that same amount of money in the shares of those 100 big companies. It basically saves her the hassle of buying 100 different shares. So the sensible suits tell her, your nest egg may grow and shrink as it tracks the stock market over the years, but ultimately it always goes up in the long run, so you'll be rich in the end. And she's like, get away from me, you suit people, you just want to charge me big fees. But then she sees an investing app called, well, something like Nest Egg. And Nest Egg is all cool and minimalist. She downloads it onto her phone. She punches in her details and the app's algorithm gets to work, allocating her money to tracker funds. Yes, it turns out the cool app is also run by the suit people, but they just took their ties off to look a little bit cooler. So wherever she turns, she's being told the stock market rises over the long term, smoothing out all the ups and downs. So just stick your money in a tracker fund, wait a few decades and enjoy your retirement on a luxury cruise ship. Now, you know how if something sounds too easy or too good to be true, then it usually is? Well, let's take a look at how the FTSE 100 performed over the first 21 years of this century. Just take a guess in your head how much the top 100 listed company shares in Great British Britain rose between the start of the new millennium and the end of 2020. Well, if you guessed 1,000%, then you were slightly off by around 1,000%. So your reward for leaving your money in a reliable FTSE 100 tracker fund for 21 years was capital loss of 7%. Yes, really. Your capital is the amount you originally invested, so 7% of that was actually lost. Luckily, there are also dividends. Many firms give their shareholders a wodge of cash twice a year. So even though the actual FTSE price didn't go up over 21 years, at least we're getting paid those twice yearly payouts. So if we factor those in, then we get total investment growth of around 3% per year. Does this mean investing is just a waste of time? Guys, cut. Let's just pack all the stuff up, okay? It turns out investing's a waste of time. I'm going to make kitten videos instead, if that's okay. Anyone know how much kittens cost these days? Not really. You could potentially do much better than that 3% if you just follow some basic guidance. And that's what these videos are all about. For a start, on a much longer time horizon, like longer than I've been alive type length, British shares have actually risen just as fast as the property market. So if you're really patient, then this stuff usually turns out okay. Also, you don't want to put all your eggs in one country basket. Yes, UK shares have had a bad run lately, but if you'd invested in the world's stock markets, then you'd have done a fair bit better, because some countries, such as the US, have seen their shares massively outperform the UK in recent years. At the end of this guide, you'll have the tools you need to start investing wisely. You'll know how to manage your risk and keep it at a level you feel comfortable with. You'll understand how to put a value on a company. And I'll show you how to set up an account and buy shares. And crucially, if you'd prefer someone else to do the work for you, then you'll know the right questions to ask any financial advisor who's helping you invest. And by the time you've watched these videos, you'll have the knowledge you need to invest profitably and swat away the scams. Your investment journey begins right here.